delighted to get this opportunity to engage with you at this event. As a regulator for banks and non-banking financial companies, I thought this could be an occasion for me to reflect on a less debated area for the regulated entities, that is their liabilities management and the challenges, attendant challenges. In flagging the mismatch between deposits and credit growth, Governor Das had previously drawn our attention to the rising challenge in this area. So I thought of wading in with a few thoughts for your consideration. The core function of banking involves accepting deposits which are usually short-term and funding loans which generally have longer maturities. Maturity transformation is thus an inherent feature of financial intermediation, and banks are strongly exposed to the associated risks. As a result, strategic management of assets and liabilities is crucial to optimize profitability, improve liquidity, and protect the banks against the various risks. Historically, the regulatory frameworks, including Basel I and II norms, had placed a greater emphasis on the asset side of the balance sheet, focusing on credit risk management and capital adequacy. This focus arises from the belief that credit defaults and asset deterioration poses the main threat to a bank's solvency. Liquidity and funding risks, primarily stemming from liabilities, were largely viewed as an issue that the banks could manage themselves without requiring any regulatory oversight or intervention. The global financial crisis of 2008, during which the banks faced vulnerabilities on both sides of the balance sheet, challenged this approach, resulting in profound changes in the banking sector's regulatory framework. During the crisis, many banks experienced liquidity crisis leading to insolvencies, despite adherence to the capital requirements, highlighting the fragility of funding structures reliant on short-term liabilities. This underscored the systemic importance of liquidity management and the need for regulatory oversight beyond the asset side vulnerabilities. The policy response was a paradigm shift that led to prescribing of comprehensive global liquidity standards through the liquidity coverage ratio and the net stable funding ratio, which targeted short and medium-term liquidity resilience. It is now well understood that liability management is crucial not only for the stability and solvency of a regulated entity, but is also a key factor influencing its return on capital as well as its growth trajectory. From the earnings perspective, the spread on interest earned on loans and the cost of funds determines the bank's net income and profitability. The cost of liabilities thus has a direct bearing on the net interest margins and the earning ratios. For instance, the share of current and saving deposits in the total deposits, the mix of retail versus wholesale funding, and the duration of liabilities play a key role in determining the funding costs and therefore the profitability of the banks. Further, the stability of funding is a key to the resilience during any crisis. In this context, let me dwell briefly on the evolution of liability management in India, the changing trends in the liability structure, the entity-specific challenges, as well as the regulatory expectations. Indian banking, all of you are aware, underwent a strategic transformation with the broader economic reforms in the 1990s. The deregulation of interest rates and greater global integration made the risks encountered by financial institutions more complex and significant, requiring strategic management. Accordingly, guidelines on asset liability management were issued to the financial institutions first in 1999, with further additions and refinements in the late 2000s, covering the interest rate and liquidity risks with further prudential limits and a disclosure framework. The prudential framework in India incorporated the Basel Committee on Banking Supervision Principles for Sound Liquidity Risk Management in 2012, followed by adoption of two minimum standards for funding liquidity, that is the LCR and the NSFR. Recognizing that LCR calibrations overlooked intraday liquidity and increasing interdependencies within the financial system that could lead to liquidity disruptions affecting payment and settlement processes, guidelines for monitoring intraday liquidity were also introduced. To mitigate the concentration risk and to curtail systemic implications for uncontrolled liability of larger banks, the Reserve Bank had very early on put in place limits on interbank liabilities for commercial banks in 2007 and interbank deposit limits for urban cooperative banks in 2009. The scheduled commercial banks, that is excluding the small finance and the payment banks and RRBs, have been permitted to set up board-approved limits for borrowing in the call and notice money markets within the prudential limits for the interbank liabilities. Such liability-based concentration limits are unique to India and reflect the Reserve Bank's early cognizance of these risks. Deposits continue to be the primary source of funds for the scheduled commercial banks, amounting to around 217 lakh crores, representing about 77% of the total liabilities as at the end of fiscal year 2024. In contrast, capital funds, that is capital, reserves and surplus, and borrowings each constitute around 9% of the liabilities. The comparison of data between the fiscal year 2016 to between the period 2016 to 2024 indicates that deposits have grown at an annual rate of around 10%, aligning with the overall balance sheet growth, and their contribution to total liabilities has remained around 77%. Meanwhile, the borrowings have grown at a lower rate of about 7%, as a result of which its share in the total liabilities have declined from 11 to 9%. On the other hand, capital funds have grown at close to 13% and its share has increased progressively from 7.6% to 9.3%, indicating deleveraging of the bank's balance sheets, boosted by higher profitability and capital raising efforts. Maturity-wise, during the same period, the contribution of term deposits has declined from 65.8% of total deposits to 60.9%, while the share of savings and current deposits have increased from 25.3% and 8.9% to 29.2% and 9.9% respectively. Consequently, the CASA ratios have improved from 34.2% to close to about 39.1%. This trend may have contributed to improvement in the net interest margins of the scheduled commercial banks, which has increased from 2.6% in 2015-16 to 3.3% in 23-24. Apart from deposits, bank raised liabilities in the form of debt capital instruments such as additional Tier 1 AT1 bonds and the Tier 2 bonds. Furthermore, the banks are permitted to issue domestic long-term bonds to finance infrastructure and affordable housing, and can also raise funds in the overseas markets under the ECB route. For non-banking financial companies, borrowings are a significant source of funding, amounting to rupees 34.46 lakh crores, or 68% of the total liabilities as at the end of March 2024. Within borrowings, debentures and borrowings from banks are the main contributors. This makes the NBFC liabilities more market-driven and sensitive to interest rate change as compared to that of the banks. When we look at the changing trends and challenges, what comes out is the fact that the banks are at the forefront of providing credit to productive sectors of the economy by channelizing household savings, which currently comprise approximately 2/3 of the gross savings. Recent trends indicate a shift in the household preference to financial assets for saving purposes, leading to movement of these savings beyond the traditional bank deposits towards capital market assets. This shift is driven by several factors, including the targeted efforts to deepen the financial sector, the growth of the digital public infrastructure that offers convenient and frictionless access to capital markets, changing investment preferences due to demographic shifts, increased financial awareness, and the recent periods of sustained high returns yielded by the equity markets. Additionally, the rise of alternate asset classes, search for higher yields, and portfolio diversification have further fueled this trend. Over the past decade, the number of subscribers and the assets under management of the mutual funds, pension, and provident funds as well as that of the insurers, has risen significantly, a trend which is likely to accentuate further. While this trend may not alter the aggregate funding available for banks, it may change the character of deposits, having implications for the cost of funds and the margins for banks. Although CASA deposits have improved over the longer term, as previously mentioned, there has been a recent shift with the share of CASA deposits declining and that of term deposits, especially in the higher interest buckets, increasing. I think that has been highlighted in the recent financial stability report. This has implications for the bank's net interest margins and profitability. Lately, the banks have also increased their reliance on short-term funding through certificates of deposits, and the average CD outstandings have reached the levels last seen in 2012. Banks must, however, take cognizance of the fact that higher reliance on short-term liabilities can have its own repercussions if the market conditions deteriorate. Banks adopt distinct liability sourcing strategies based on their competitive strengths, their market positioning, and the business priorities. Large banks with extensive branch networks may have access to low-cost, stable retail deposits, while the banks with more pronounced urban presence may target the affluent customer segments, offering high-value deposit products tailored to high-net-worth individuals and corporate clients. Additionally, some banks with advanced technology stacks leverage digital platforms to enhance customer acquisition and streamline liability sourcing, providing a competitive edge in attracting both retail and corporate deposits. On the other hand, differentiated banks are seen to be having higher reliance on interbank deposits and wholesale funding. This diversity in funding profiles presents a unique challenge in asset liability management, as each business strategy introduces its own complexities in managing liquidity, cost of funds, and the risk alignment. Institutionalizing of deposits, which I referred to earlier, will bring along specific challenges in asset liability management for banks. A reduced reliance on retail deposits, coupled with a greater share of funding from institutional sources, will likely result in increased funding costs, which can in turn negatively affect profitability. The quest to maintain margins can lead to eventual transmission of increased funding costs to the interest rates on loans. This would either constrain growth of the loan book or may force the lenders to dilute underwriting standards and lend to riskier borrowers to maintain the earnings ratio. Banks must stay alert to the risks of certain practices that may seem less evident during periods of strong economic growth but could lead to serious consequences during the downturns. Banks heavily reliant on wholesale borrowings or uninsured deposits are more vulnerable to rollover risks and outflows in times of economic stress. Therefore, effective liability management is crucial for mitigating these risks. Another issue pertains to deposit growth of certain banks not keeping pace with their loan growth, which has raised regulatory concerns about the risks associated with higher dependency on wholesale funding for credit disbursements. Such imbalances are viewed as indicators for potential structural liquidity vulnerabilities. While regulators monitor these trends as a macroeconomic gauge to assess systemic risks in the banking sector, it is crucial to recognize that for individual banks, these indicators alone are insufficient to fully capture the liquidity risk. From a short-term liquidity perspective, tools like liquidity coverage ratio offer a more nuanced view by considering factors such as the deposit stability, deposit behavior, and dynamics between retail and wholesale funding. The relationship between these indicators is multifaceted and often contradictory, making it essential to avoid relying on any single measure in isolation and necessitating a holistic assessment of the asset liability management profile of the bank. Contrary to banks, the liability profile of the non-banking financial companies is shaped by their primary activities, the regulatory requirements, and the type of assets that they finance. Historically, crises have demonstrated that NBFC's over-reliance on short-term funding to support long-duration assets, such as infrastructure and housing loans, can result in significant liquidity constraints, deterioration in investor confidence, and credit rating downgrades, thereby constricting their ability to access capital markets. Consequently, NBFCs become heavily dependent on bank funding, both direct lending and bank subscriptions to debentures and commercial papers, leading to funding concentration. Recognizing the increasing dependency of NBFCs on bank borrowings, Reserve Bank had increased the risk weights on bank exposure to NBFCs by 25 percentage points in November 2023, which has helped in moderating the year-on-year growth in bank borrowings by the NBFCs. To offset this, the NBFCs have increased funding through CPs and non-convertible debentures. While accessing international markets can reduce the NBFC's reliance on domestic banking system and provide a broader range of funding options, it is also exposing them to additional risks, particularly the unhedged currency exposure, which can lead to volatility in funding costs and potential liquidity strains due to exchange rate fluctuations. NBFCs should integrate forex hedging with their ALM framework and closely monitor the currency exposure to mitigate funding volatility. The liquidity transformation of assets through securitization to free up resources for on-lending can also serve as an important tool to improve the ALM structure. Now let me flag a few issues that are being extensively debated globally on the ALM practices employed by the banks and NBFCs and the regulatory expectations on these issues. First, the rise of innovative products and technologies in banking has enhanced consumer flexibility in accessing funds and managing cash flows, significantly transforming customer behavior. Further, the evolving dynamics of information dissemination through traditional and social media can profoundly influence customer behavior, potentially escalating and amplifying in a crisis, or even amplifying a crisis. These factors present heightened challenges, and the banks and the NBFCs need to be watchful and carefully review their modeling assumptions on the stability of deposits and the customer behavior to better predict deposit retentions, the withdrawal patterns, the prepayments, and the interest rate sensitivities. Second, the liability-driven investment crisis in the United Kingdom demonstrated inherent vulnerabilities in a highly interconnected financial system, where the failure of one segment can precipitate cascading liquidity challenges across multiple sectors. Traditionally, liability management models, often based on historical data, may not adequately capture the risks posed by unprecedented market conditions. Consequently, the regulated entities must develop a more sophisticated stress testing methodologies that can evaluate the ability to withstand extreme scenarios, including those that involve the amplification of shocks across the interconnected financial networks. The final point is the importance of contingency funding plans. In general, the regulated entities must have formal contingency funding plans commensurate with their complexity, their risk profile, scope of operations, and their role in the financial system. Among others, it must clearly articulate the available potential contingency funding sources and the amount of funds that can be derived from these sources. It's important to note that the lender of last resort function of the central banks is regarded as an implicit assurance or an implicit insurance for banks against liquidity shocks that money market participants are unwilling or unable to absorb. The value of this insurance increases with the bank's exposure to liquidity risk, which consequently increases the moral hazard. Banks need to recognize that to address this moral hazard, the central banks retain the discretion to decide whether to extend emergency liquidity assistance to specific institutions. The assistance is intended as a safety net for the entire financial system through judicious use of public funds and is often accompanied by supervisory intervention and conditionalities. Therefore, the LOLR function should not be regarded as a routine component of contingency funding. As far as NBFCs are concerned, while they play a key role in enhancing access to credit and supporting growth, their activities involve a significant amount of maturity, liquidity, and credit transformation. Most NBFCs, unlike banks, do not have access to public deposits, as the regulatory approach over the years has been to disincentivize the deposit-taking activities of the NBFCs. Compared to more stable retail sources of funding available to banks, given their access to official backstops and deposit franchises, NBFCs will continue to be dependent on banks and capital markets for their funding. It's imperative for NBFCs to diversify their funding sources while optimizing borrowing costs and mitigating the associated risks so as to be on a sustainable growth path. Today, we collectively aspire for a Vikasit Bharat by 2047, the centenary of our independence. This ambition demands consistent and sustainable economic growth combined with a systemic capacity for resilience. In order to achieve the ambitious economic growth targets under this vision, the financial assets and the banking assets would need to achieve a high and consistent and high-paced growth over the next 2 decades, which would require a corresponding increase in liabilities and capital for the financial sector. This brings forth the need to address some of the emerging challenges as customer behavior and preferences are undergoing profound changes, while the global ecosystems and the external factors such as third-party dependencies and technology shifts are growing increasingly complex, thereby which is reshaping the business landscape. Collectively, these dynamics are creating a challenging environment for the regulated entities who would need to recalibrate their approach and business strategies. This is not just about managing risks, but also seizing the opportunities to optimize funding structures, enhance stability, and support economic growth. The road to a Viksit Bharat by 2047 will depend significantly on how well the financial system adapts to these trends and manages the complexities of raising resources and liability management. Thank you.